Good afternoon, everybody, and welcome to this week's installment of TRU Snacks. My name is Steve Ronan, the host of today's webinar and the leader of Citrin Cooperman's consulting and outsourcing practices. As we do every week, today we'll bring you snack-sized insights on a timely topic delivered by experts in the field. Today we'll be discussing fundamentals of wealth preservation with Rob Brown and Todd McDonald from our wealth management practice, Apexium Financial. A few administrative reminders before we start. We'd like to accept questions throughout the webinar. So please look at the bottom of your Zoom screen and locate that Q&A button. Please put your questions right into that box as we go. Some we may answer during the course of today's discussion, and some we may reserve for the end. In the event that we are not able to get to all questions today, we will follow up personally with everybody who enters anything into that window. Additionally, we will be doing our traditional snack basket giveaway, where a lucky attendee will be randomly selected to receive a craft basket of snacks. The winner will be announced at the end of today's session, so please stick around for that. Finally, if you found today's session on our website or on social media, I encourage you to sign up for our mailing list to receive an invite every week for our new topics. Please also consider visiting our TRU Snacks Content Hub on our website to see the decks and recordings of prior presentations. And without further ado, I'd like to turn it over to Rob Brown from Apexium to begin today's session. Rob, over to you.
Steve, thank you very much for the introduction. And hello, everyone. Happy to be here with you today. I will be presenting with Todd McDonald. And Todd, slide to the next slide, please. So Todd is the Director of Investment Strategy at Apexium Financial, and I am the in charge of wealth management. Apexium is an affiliate of Citrin Cooperman. And as I said, we're very happy to be with you today. Next slide, Todd. So here's our agenda for this Zoom call. We're going to initially start out by discussing the wealth management puzzle, what we refer to as this puzzle, and wealth management principles that we hope that you are following. Then we're going to move into investing, a conversation about time in the market versus timing the market. And then we'll transition into risk return and how the low interest rate environment that we are currently in is impacting the way we think about portfolios and designing portfolios. And then finally, we're going to give our view on what we call the portfolio of the future, where we think the market is going and portfolio construction processes are heading. So let's dive right in. And fundamentally speaking, these are what we feel are the pieces to the wealth management puzzle. So retirement planning, how much income do I need to have a smile on my face throughout retirement and not run out of money? Tax strategies, asset allocation decisions, business succession planning, survivor income, guaranteed income, charitable giving, budgeting, wills and trusts, investments, insurance, education for children and grandchildren, asset and income protection, estate planning, and legacy, what we're leaving behind in both in dollars and in terms of in philosophy to our family. So generally speaking, our role as advisors is to help clients put this puzzle together. Most often, the puzzle comes in, if you just think about a puzzle at home, when you dump it on the table, all the pieces are just kind of uncoordinated and possibly not really thought out together. So what we try to do is put together a comprehensive plan. And some puzzles, again, to use the analogy at home, can be put together very simply by a fourth grade student. And other puzzles take a long time and a lot of people to put together. So the same thing happens with financial planning. Some plans are very straightforward. Other plans are much more complicated. But the reality is, what needs to happen is a conversation about who's going to be on your team and who's going to help you put these puzzle together, so you're thinking about all these decisions holistically. So I'd like to move to what we talk about with clients is financial planning principles, what we really feel are important. And the number one thing is have a plan. And what I mean by that is, let's say, for example, somebody needs $30,000 per month to retire. That's the income goal that they have. Really what needs to happen is you have to work backwards and figure out, what do I have to do today let's say I'm 55 years old and I want to retire at 65. What do I need to do today to make sure that I can achieve that objective, that I can meet those goals? How much money do I need to save? What type of rate of return do I expect in the portfolio? So that's the number one thing, is just having a plan. And ultimately, if you think about dumping a puzzle on the table, is just getting all those pieces organized in a comprehensive, thoughtful way, and really putting some thought into where you want to go. The next thing is understanding the tax rules. Most people are very familiar with income taxes because we're required to pay them every single year. Similarly, if you have an investment portfolio and you have gains in that portfolio and you make a sale in the portfolio, you have to contend with capital gains in the portfolio and the tax around that. The third tax system, which we feel doesn't get addressed as often, is the estate tax system. And that is the tax that's applied if we're transferring assets from generation to generation. And I want to stay for a moment just on estate taxes, and the reason why, when President Trump came into office in 2017, he dramatically increased the amount of capital that a family can leave from generation 1 to generation 2, or from generation 1 to generation 3. And that number is currently, between a married couple, there's approximately $24 million can be left on a federal level without estate taxes. That number is scheduled to be cut in half on January 1st, 2026. And Biden's plan is to reduce that number to $3.5 million per person. And we're not sure when that's going to happen, if it gets through this year, retroactive to January 1st this year, or if it's something that's going to be on the docket for year end in 2022. My point in bringing up the estate tax system is that it just needs to be thought of as you go through the plan. And our experience is that a lot of clients don't spend enough time thinking about estate tax planning and how you can be efficient in that regard. Another financial planning principle: managing for risk. Obviously, while you're younger and building a portfolio, you have life insurance and disability insurance is very important. Life insurance can also play a role as assets grow in the estate planning process. For example, if we have a family that owns a lot of real estate or a closely held business and is looking to transfer that business to the next generation, and there's also an estate tax issue, life insurance is often used to manage that risk. Next one is liability insurance. I want to talk about this for a brief moment. About 20 years ago, I was having a conversation with a prospective client. They were doing very well and had a significant amount of capital. They were in a car accident. They ended up losing a $3 million lawsuit in the car accident, and they had $300,000 of liability protection on their car. They had no umbrella insurance. They ended up losing $2.7 million out of their portfolio just because they did not have the right plan in place. They didn't have the right risk management plan in place. So if I can use an analogy going back into medieval times, wealthy families used to build castles, and the larger the castle, the larger the moat. And just, we all need to be thoughtful about liability protection and asset protection. We live in a very litigious society, and that is one of the things that we see time and again, where clients have not spent a lot of time focusing on, but we need to make sure that that is in good order. And then finally, for managing risk on investments, we'll talk a little bit about that in a few moments, and how we can protect portfolios. Another financial planning principle: portfolio withdrawal rates matter. And what does that mean? A lot of times clients ask us how much they need to retire, and the answer is, well, really, how much do you have? Because that drives everything, your expense ratio and how much you have. Statistically speaking, for every $1 million that you have invested in income producing assets, you should expect to receive $35,000 to $40,000 per year of income. And that's a ratio that's held true for many years. So I'm going to state that again. For every $1 million that you have, in liquid assets or income producing assets, the target income without risking running out of money in the portfolio is 3.5% to 4%. And if we just think about universities, endowments as an example, the whole concept here for us, one of the things that concerns us from a financial planning standpoint is clients living too long and inflation really eroding their capital and having market risk on top of that. So making sure that the portfolio lasts long enough. So withdrawal rates has to do with how much money you're taking out of your portfolio. And again, for every $1 million, you should be targeting 3.5% to 4% per year at the most. Okay. And then finally, understanding emotional biases and what they are. And the reality is we live in a world where we invest in assets, whether it's real estate or businesses or the stock market, there's volatility and there's risk. This goes back to the first principle, which is having a plan, but building emotional guardrails around that. We have to understand how much risk we're willing to take and what that means. For example, if the stock market is down 20% in a quarter like it was last year, what am I okay losing? And if you're not okay losing any money, then clearly you cannot take any risk in the stock market. So it's trying to understand your propensity for risk and that it exists. And what we need to do is avoid making that one or two knee-jerk reactions or emotional reactions, which are really going to set you back from a financial planning standpoint. So just having the intestinal fortitude to remain invested and to stick with a plan. So we have to understand and talk about these emotional biases so that we don't let them impact the success of our plan. And finally, politics. I just want to bring up politics for a moment because we've noticed in the last 4 years a heightened sense of tension around investing as it relates to politics. And if you go back 4+ years ago, when Trump initially won, the futures markets dropped tremendously, and the market recovered after that. We had investors last year heading into the election that some of them that were thought that they wanted to remain invested because they thought Biden would win, and others that did not want to remain invested because they thought Biden would win. All we want to point out with this is that who's in office generally has very little impact to stock market performance over an extended period of time. This is a really interesting chart, and it's a little bit difficult to read, but this is going back to the Great Depression in the stock market. What you're seeing on the left side is just the value of the stock market. The red bars are Republicans in office, and the blue bars are Democratic presidents. What you can see is a general trend upward. And if we look at recent history, the only president to have no return during his administration was President Bush. And Bush was in office during both the tech wreck, so the lost decade of 2000 through 2010. There was zero return effectively in that time period. So Bush was in for 8 years, and his performance, if we look at it from a stock market return standpoint, was effectively flat. So, but Obama had growth, Trump had growth. We'll see what happens with Biden's administration. I think with the amount of capital heading into the market, the trend is higher for the near term. So we'll see how this plays out. But we just thought it was very important to talk about politics and trying to keep politics out of investment decisions and really focus on long term. So with that said, I'm going to turn this over to Todd. He's going to talk to you a little bit about staying invested in the market versus timing the market.
Thanks, Rob, and hi, everyone. So just to kind of reiterate what Rob has been saying, timing the market being more important than timing the market really can't be stressed enough. It sounds easy enough, right? But as Rob alluded to, we live in a world where emotions and real life circumstances come into play. And as a result, investing with a long-term view is really much easier to say than to do. As Mike Tyson says, everyone has a plan until they get punched in the mouth. So this chart is showing us the return if an investor bought the S&P 500 at the absolute worst time. This is the top of the market in 2007, right before the great financial crisis, but he never sold. Despite the initial 50% plus drawdown, they would have tripled their investment in under 14 years just by sitting on their hands. Now, you'll also notice the blue shaded lines, which are all of the corrections of at least 5% that this investor would have had to endure along the way. Fidelity actually did a study recently where they found that their best performing accounts were held by people who had been dead for years. So in short, the effectiveness of any investment strategy is really only as good as your ability to stick with it through the bad times. So now let's look at the most recent example, still very fresh in all of our minds, and let's put some real dollar values to it. In 2020, the S&P experienced its fastest 30% decline in history, dropping 34% in just 1 month's time, only to end the year up almost 18%. Now, during the sell-off, there was no shortage of bearish prognostications. Bill Ackman, a well-known hedge fund manager, going on CNBC in mid-March, saying that hell is coming, really comes to mind. So now let's assume that two investors had $1 million invested in the S&P 500 in February 2020. Investor one sold near the bottom in March to wait for the dust to settle and never reinvested. Total value of their account is now around $670,000. Investor two did nothing. The total value of their accounts now is about $1.2 million. So in 1 year's time, a bad decision, an emotional decision, could have resulted in a permanent reduction in wealth. And it's not just 2008 and 2020 that have gone through difficult periods. These drawdowns happen every year, and they're always scary, with the media highlighting how many points the Dow is down and reiterating all the things that were wrong with the markets. The average annual decline from peak to trough over the last 40 years has been 14%. This graphic shows us the best and worst outcomes on a rolling 1, 5, 10, and 20-year periods for owning all stocks, all bonds, and a 50-50 blend between the two. So essentially, this is showing us how the combination of time in the market, along with diversification, have helped narrow the dispersion of potential outcomes an investor may have experienced since 1950. So traditionally, advisors work with clients to determine their goals and risk tolerance. And then at the simplest level, they choose an asset mix between stocks and bonds to design the optimal portfolio from a risk and return perspective. Equity being the risk part of the equation, and bonds are the ballast used for diversification while also providing income. The general idea of this is that fixed income zigs when stocks zag, and you simply rebalance every so often to get to your target allocation. Now, historic and persistently low yields have really diluted the effectiveness of this approach on a forward-looking basis, with the traditional inverse correlation of stocks and bonds becoming a lot less reliable in recent years. The most recent 10-year average correlation between stocks and bonds was about 0.45. And just for context, that figure was almost always negative before 2009. So as you look at this chart, the starting yield on a 10-year treasury note is highly correlated to the subsequent 10-year return on a diversified bond index. So you more or less know what you're getting when you invest. So as of this morning, the 10-year yield is about 1.45%, which is up significantly recently, as it started the year well below 1. Further, the yield per unit of duration, which is just another term for interest rate risk, has really never been worse. It's currently sitting at a 0.2. And just for anyone that doesn't know what duration is, so bond prices move inverse to rates, right? And the simplest way for me to explain this is that if you lock in money at 1% return, and then a week later, prevailing rates are 2%, no one is going to want to buy the bonds from you at your original price when they can simply do better on the open market. And this doesn't even consider if fixed income at these levels, it's unlikely to even exceed inflation. So this essentially creates a nearly certain loss on a purchasing power basis. So if bonds are no longer a ballast, other than being not equity, and they offer little to no yield, should they still be used in the same way as they always have? So one last slide here to drive home how difficult lower yields make achieving the same return over time. So here, to earn 7.5%, an investor in 1989 could simply hold 25% of their portfolio in bonds and 75% in cash. So risk assets could effectively be ignored. 15 years later, in 2004, it becomes a bit more difficult and we have to introduce some risk assets and we don't hold any cash. And then in 2019, to achieve the same 7.5% return, an investor had to take 6 times the risk that they did in 1989 with investments in private equity, real estate, small caps, and international equities. So you may be asking, how do we solve for this complexity while also keeping clients invested for the long term? And I'll hand that back to Rob to explain further.
Todd, thank you very much. So just to recap, we talked about some financial planning, wealth management principles. Then we moved into timing the market versus timing the market, and talking about the low rates. And this is a snapshot of what we think portfolio is going to look like on a go-forward basis. And as Todd mentioned, we have to think differently about portfolio construction. And we really have to consider whether owning fixed income is going to provide us with success over the next decade and beyond. It worked for the last 40 years as interest rates decreased. But again, now that we're at a very low interest rate environment, we have to think differently about how we want to imagine portfolios going forward. One of the things we noticed institutions doing, institutional money, you're talking about billions of dollars of assets, is they're using equity derivatives to protect the portfolio instead of traditional fixed income. So what we expect to see over the next decade is a real increase, a real growth in the use of equity options to protect portfolios. So we see the portfolio of the future as a combination of passive, low-cost, tax-efficient index funds. So just think of Vanguard or an S&P 500 index fund with an equity option overlay customized to the risk level of a client. And that combination is what we think is going to replace the traditional stock and bond portfolio. I want to take a step back and just talk briefly about options. They've been in the news a lot, and some of you may have heard of GameStop and some college kids making a tremendous amount of money and others losing a tremendous amount. Options can be used for 3 specific things. They can be used for speculation, as we saw in GameStop, which is highly risky, or they can be used for hedging or income. So if you start to think about options as a way to hedge the portfolio or provide income, just like institutions use options, they become a very valuable part of the portfolio construction process. So we bring this up because many of you on the phone likely have never used options in your portfolio. And it's something that we think you should start to become familiar with because we do think it's going to become part of the portfolio of the future. So we are going to take this time to just pause, and we'll end here, and we'll open up to any questions. If anybody has any, we're happy to answer them now, or we're happy to take questions after on a one-on-one basis. Steve, I'll hand it back over to you.
Great, thanks a lot, Rob. Really appreciate the insight. So, question came in: how do investors think about gaining access to other investment options to outpace the S&P 500, or how should they be thinking about that in the context of their portfolio?
I mean, that's a great question. So there are two parts to that question, Steve. So we have to understand where the assets are being invested. If it's invested inside a 401k plan, there are going to be a lot of restrictions on what investors can own. And that's part of that is ERISA law. And the other part is if you have an employer sponsoring a plan, generally speaking, they're driving towards target date funds. And that simply means they will target the portfolio to be structured in a way that's timed with retirement. So if somebody is closer to retirement, the portfolio will have less risk. And if somebody's just out of college and working, the portfolio will be much more focused on an equity allocation. Now, outside of retirement plans, the options are really limitless and really dictated by how much money somebody has. And we can think about private equity investments. We can think about using options as an overlay. We can think about thematic investments, which Todd can take a moment on and talk to you about some of the things, best ideas in that type of strategy. So listen, it really depends, and it has to be built in as part of a greater, part of a financial plan. So I think the question that everybody really needs to ask is a financial planning question. How much money do you have? How much are you saving? What are your goals and objectives? And if we're going to take more risk in the portfolio, can you afford to lose money? And if so, how much can you afford to lose? And will that make you make an emotional decision and sell at a low? So we have to really throw all that into the blender and see what comes out. Todd, you want to spend just a moment talking about a couple themes from the investment side that we've invested in recently?
Yep, sure. So at Apexium, we think it makes sense to put a small part of your allocation towards certain things that may necessarily not be reflected in, let's say, the S&P 500. So that's just the largest 500 stocks within the United States. But there's over 5,000 stocks available for people to invest in. So what we look to do is identify certain themes or trends within the market, whether they be secular, but we look for a 1 to 3 to 5 year term where certain investments that are not in the S&P we can get exposure to. And why we've recently started to do this is it wasn't easy to do even 5 years ago. But with the proliferation of all the different sector themed ETFs or just many different investment vehicles that we could potentially go into, now it is possible to do at a low cost and intelligent way. So we've been looking at things like U.S. cannabis, the genomics and healthcare, clean energy. And we even have looked at things such as the reopening play. So, plenty to digest there, but we're always looking out for things that can potentially beat the S&P, and they have a thematic benefit to them. So they have tremendous tailwinds. So that's how we look at thematic investing.
All right, that's great. Well, we're at the end of our time. Rob, Todd, thanks so much for joining us today. Really appreciate the time. We had a few other questions come in that we will be happy to have Rob or Todd follow up with the folks who asked that offline after this session. So as we close it out today, would like to give our winner an announcement for the snack basket giveaway today. That's going to go to Michael Green of Contemporary Motor Cars in Little Silver, New Jersey. So thank you, Michael. We will be following up with you offline to get shipping information. I'd like to point everybody's attention to the sessions that are coming up next. So next week, we will be joined by Carlos Catalano, director in our consulting practice and one of our technology partners, Plenidata, to talk about how to automate the finance and accounting function using accounting robots. So that's a fun video-centric presentation. The week after that, on March 11th, we'll be talking about state and local tax considerations for managing a remote workforce. And then on the 18th, we'll be joined by David Lewis, the CEO of Operations Inc. and one of the premier national experts in HR and talent management, to talk about the roadmap to reopening, how to handle a post-COVID workplace. So I would invite you to sign up for those sessions. You will receive an email following today's session with a link to the recording and the deck for today, as well as an invitation to sign up for our newsletter. I would encourage you to do so. And until next week, I wish you a happy rest of your Thursday, Friday. Have a great weekend, and we look forward to seeing you on a future session. Thanks so much for joining today, and take care.